Welcome to the NISM Masterclass. I am your host Sashi Krishnan, and our purpose at NISM is capacity building for the securities market ecosystem. And as part of that purpose, we sit down with the gurus of the securities market to get a better understanding of their journey and gain deeper insights into the various facets of the securities markets. And my guest today is Praveena Rai. Praveena is the Managing Director and Chief Executive Officer of MCX, that is the Multi-Commodity Exchange of India Limited. MCX is not only India's largest commodity derivative exchange, it is one of the largest commodity derivative exchanges in the world today. And Praveena is a veteran of the financial services industry. I think she spent more than 3 decades, in various senior roles in the banking and the digital payment space. Welcome to this masterclass, Praveena. There are not as many people who are familiar with the commodity markets as they are with the equity markets. Could you give us a little bit of a sense as to, the entire commodity derivative ecosystem and the role of the exchanges in the commodity derivative ecosystem?
Thank you, Sashiji, for having me here. I'm really looking forward to this discussion. And this is a great place to begin, because when we look at commodity derivatives, it's really a financial instrument which, as the name suggests, is derived out of an underlying commodity.
Right.
And it helps to create a financial transaction in a regulated, fair, transparent mechanism out of an underlying commodity. So it becomes tradable, it creates a lot of value addition in the whole process, right, and helps to really bring together the physical and the financial markets.
Right.
Now, the role of an exchange here is to really permit participants, both from the physical side of the commodity trade as well as financial participants, to come together to trade, as the name suggests, right, on an exchange.
Right.
So that's really the genesis of the commodity derivative as an instrument, as well as the commodity derivative exchange and the role that the exchange plays.
Yeah, so let me, as a follow-up to this, ask you, what is the benefit, of making commodities a part of your investment portfolio? Often it is argued that commodities itself, commodities like gold, commodities like oil, they have a negative correlation to equity. So sometimes it is argued theoretically that it is a natural hedge against equities. Similarly, it is argued that it is a natural hedge against inflation. With so much of geopolitical uncertainty, maybe it's a proxy to global economic growth also. So what exactly would be the reasons why somebody should have commodities in their portfolio today?
I think you said it perfectly. And if I were to just expand on that, if you look at what really we call inflation,
right,
inflation is a basket of commodities.
Right, exactly.
And commodity is underlying to that. So if the economy has a certain percentage of inflation, and if you've invested in a commodity, you have naturally absorbed that sort of inflationary impact on your portfolio. Now, commodity also not just operates in the domestic market, but is also has a strong interrelationship and correlative factors with the global economy, because we do have a lot of import, we have exports, we have a lot of domestic value adds, and so on and so forth. We can discuss that in more detail. But all of this comes together to really make this not just a domestic sort of an investment, but really a global investment of sorts. And the third, and this is sort of over time, it looks at both the currency market as a positive correlation and does have some level of a lower to negative correlation with the equity market. So in a way, if a portfolio has a certain percentage of commodity derivatives as an asset class, then you do have a class that is operating fairly independently and different from either deposits or debt or equity or anything else that could be part of a portfolio.
Right. So, so in all these three aspects, that is inflation, equities, and the global markets, commodities are correlated, and that correlation itself, could make a very big difference to how your portfolios perform. Is that the way one should look at it?
So, looking at a commodity will mean understanding the underlying commodity.
Right.
So, I mean, it's because commodity is not one investment, right?
Correct.
Just like in an equity, you have to decide on whether you're investing in a stock or maybe in a mutual fund, or whether you're going for a SIP. Similarly, those options are there when it comes to commodities, right. And one will have to decide which is a commodity or is it an index. So that due diligence, etc., will need to be made. But at a larger portfolio level, it certainly has an interplay and provides a space quite distinct and different from the other asset classes.
So this choice of commodity, so assuming I choose to invest into gold as a commodity, or a gold future, or a gold option, or a gold derivative. Now, what benefits do I get from investing through a derivative, a gold derivative, rather than investing directly into gold, or, for example, investing into an ETF, a gold ETF? So why would a gold future be as good as, if not better than, a gold ETF, or gold, the physical gold itself?
I think the first would be tradability, right? So if you're really treating it as an asset class and not, let's say, as a piece of jewelry, right. Then you want tradability out of it. At some point, you want to know that it is liquid, right? And the second thing that you would like is that you're able to risk manage potential volatility. So if you are investing today, and you say that, look, I want to hold this for a few months, or whatever period of time you decide,
right.
You have a certain outlook.
Correct.
You believe the price will go up or the price will go down, and depending on that, you're taking your position, and you want to ensure that that underlying view holds, and you want to manage that risk
right.
of the counter position playing out in market.
Right.
So that's where the hedge position starts to hold good.
Right.
In addition to the fact that it is also tradable.
Right.
So if you want to sort of exit your position somewhere in the process, and you want to really financialize it, and you want to cash out, that opportunity exists. So it operates very differently from physical gold, or
right.
From a sort of simple ETF transaction, and gives you a lot more volatility and play. But let's bring it to the real world, right? Let's say somebody is planning for a wedding.
Mm-hmm. Yeah.
Then rather than looking at, hey, I'm going to look at gold, purchase gold in market at a particular point in time, or
right.
I want to buy it and keep it, but I don't know really when I'm going to use it.
Right.
Then you could take a future instead,
right.
Which then helps you to lock in a certain price. What your budget is.
Correct.
What you're gunning for as and when it happens.
True.
And there are many such use cases in the market, that between retail, but certainly retailers as well, the folks in the gold, in the bullion business,
right.
They very smartly, utilize these
right.
tools and instruments in how they manage their business risk, and even productize these offerings during festive season and so on, in sort of price protected offerings to market.
Right. What about leverage? Because this is an opportunity for you to use leverage better, using the futures market rather than physically buying that gold, isn't it? So is that one of the reasons why people use it?
Of course, that exists as well.
Right.
Yeah, especially when it comes to options, and you have to basically look at how much margin you need to use rather than the entire outlay.
Correct, exactly.
Yeah, clearly that also is an advantage.
So the next question I had, Praveena, was that the volumes that we have seen being traded in the commodities derivative exchanges, they've almost doubled over the last 1 year. Like, in 2024-25, we had something like 281 lakh crores. Last year, we had something like 578 lakh crores. And we've seen this, significant move in terms of the volumes that are being traded in the exchanges, the derivative exchanges. So, I mean, this particular trend, how do you explain this particular trend this kind of an interest into the derivatives market?
Yeah, I think it's a beautiful coming together of few things.
Right.
But at a very high level, I think this is reflective of the maturity of our capital markets in general.
Okay.
Because we do need players who come in, investors who are participating,
Right.
who are not just looking at the vanilla kind of offerings, but who are ready for an understanding of more evolved instruments like derivatives.
Right.
So I think the first port of play is equity, because people understand equity better, so equity derivatives. And having understood equity derivatives, now they're saying, hey, there's also another instrument called commodity derivatives.
Right.
Let's get there. So I see that as like a natural evolution. And if you actually look at the volumes of, how equity derivatives has grown, you'll see that this is sort of stalking that in some
Right.
way. It's
Exactly.
trailing the graph.
Yeah. Right.
The second play would be the commodity market itself. And that really comes back to the India story. And the whole India story, not just the growth and everything we are seeing by way of GDP, 6% plus, we are practically the only country in the world. But a lot of this is also being driven by infrastructure growth, the kind of construction we are happening, growth of consumerism, urbanization, so all underlying sort of macroeconomic factors.
Right.
But each one of these drives growth in commodities. So for example, if you look at copper gets tightly linked to construction, and nearly 3% plus of like construction GDP is contributed by copper.
Okay.
You can look at steel.
Right.
And similarly, when it comes to manufacturing, steel is, and all commodities are sort of universal intermediaries. So they really go and play in so many other industries. And with the boom in manufacturing and a lot of infrastructure, construction, you see steel being very underlying to that. Overall growth, positive sentiment, consumerism drives bullion, the whole story around gold and silver. So I think the underlying story of India's economic environment, the global factors in play around volatility, all of that also brings in a big macro factor into why commodity derivative starts becoming very important now. And the third is, of course, it has I would say a bit more internal, where with the growth that the exchange was seeing, we had to get our sort of platform upgraded and a bunch of actions that we had to take. And we are now more ready for what I would say really building this market out. So I think all of these factors kind of coming together, which has led to the state of growth.
So let me just pick up one point out there. So you mentioned steel.
Mm-hmm.
Now, I don't think we have an underlying derivative on steel today in the market. So there are a lot of opportunities, because as the economy grows, there will be more and more sort of interlinkages with commodities, and therefore there will be introduction of derivatives on many of these commodities that are currently not there.
Absolutely. I think products are a very important part of what this market requires.
Right.
And what from an MCX standpoint we also intend to play out. There is a steel contract. It's called the steel HRC contract.
Okay.
Sorry, the steel rebar contract.
Steel rebar,
yeah.
right.
So
okay.
Steel has, they call it flat and long. So this is the steel rebar contract.
Right.
So it's a newish contract, so sort of just building up in market.
Okay.
And there's a very interesting anecdote on steel.
Right.
So somebody was building a house,
mm-hmm.
and they did a fixed bid with the contractor.
Correct.
So the contractor said, yes, no problem, I'll do all of this, plus minus I'll absorb. But steel, anything that happens to the price of steel, you're going to bear.
Right. It's going to be a pass-through.
It's going to be a pass-through.
Right.
If this is my price, then, if I get less, I'll give it to you. Or if I have to pay more, you've got to pay for it, right? Because that's such a big contribution
such a big part of that construction of a house.
That construction cost.
Right.
And so when hedging is not there and being deployed, this inefficiency creeps in across the entire value chain. So those are a very simple example at a very sort of retail level.
Right.
But if you look at the whole industrial value chain,
correct.
That's really the role that can be played. So you need commodity contracts across every sub-segment of that value chain.
Okay.
And only then will will the real opportunity of efficiency kick in there.
So let me, again, in a follow-up to this, do global markets have this entire range of commodity derivatives available today?
Absolutely.
They have.
Absolutely. If you
So
look
it's only a question of time before they come into the Indian markets.
If you look at well-established markets, right, which have been at the core and essence of global trade over the years, in the US or Europe, they play this role. They played it for a long time. But even if you look at newer markets, if you look at what's happening in China, for example, they've done a phenomenal job for what the Chinese industry needs, for what the Chinese economy needs.
Okay.
And I think ours as well will not be a cut-paste kind of a, hey, these are the kind of products happening globally, so that's what we've got to do in India. They've got to be reflective of the growth opportunity in the country, the dynamics of where our growth is happening, where do these commodities play a role, and hence what are the kind of sort of value chain products we need to bring.
So they'll be very specific to the Indian context. Right. So coming back to the participants in this market, see how involved are the domestic financial institutions and the foreign portfolio investors in the commodity derivatives market?
They're relatively newer participants on the domestic institutional space as well as in the foreign institutional space. For commodities, there are some, would I say, regulatory and kind of policy guardrails that have been established many years ago, and at that point in time it would have been relevant, which today we'll have to start loosening up a bit. So I think that's all a little bit of work in progress. So I will say that there are components that have started flowing in. We have a number of foreign participants who signed up, onboarded. We've seen early flows kick in. But getting overall, it's a great point that having deep institutional participation will play an important role to create or deepen further the liquidity,
price discovery.
The price discovery, the liquidity, which is very critical for the physical participants as well.
So you see more and more participation from domestic and foreign portfolio investors in the market over the last couple of years. You've seen that?
Yes.
Okay. So coming back to the hedgers itself, right? I just wanted to understand that many of the hedgers use, for example, the London Metal Exchange or the Chicago Mercantile Exchange to hedge their positions, especially many of the manufacturers and the large corporate houses, etc. So do you see them coming back to the Indian commodity derivatives markets to hedge their positions? You see a larger activity over there?
So when Indian players are hedging overseas,
right,
it's at best a surrogate hedge.
Okay.
Right? Of course, if they're importing something, it's a direct hedge. If they're exporting something, it's a direct hedge.
Correct.
But in all other situations, they also have to hedge currency, which is fairly volatile in itself. And they have to account for the price at which is being imported, which could be in dollars, the conversion, the local logistics, and the dynamics of local demand supply. All of this adds a certain cost and a certain variability of that cost.
Okay.
Right? To the base.
Right.
Now, the more within India is the value add, the larger is this contribution.
Right.
So if it's import and use, then it's simpler. But if you're, for example, if you take aluminum, for example, right? The ore is in India, we mine it in India, we refine it in India, the entire value chain is in India, and then we export.
Right.
Right? Now, why would this industry
want to hedge somewhere else? Correct.
Right? So I think that's the play.
Right.
We need the right products, and we sort of need the opportunity to be opened up, and a good understanding across the value chain of the cost components and the volatility thereof.
Right.
So that today the efficiency or lack of it, which is passed down the entire chain, ultimately borne by the consumer, can then be managed better. And all of this is happening as we speak.
Okay. So it's fundamentally a question of once the products are available on the Indian exchanges, you would see them sort of coming back to the Indian exchanges. Is that?
Yeah, they are available now.
Oh, they are already available.
Yeah.
Right. Okay.
I mean, we can do more, but they are inherently available.
Okay, available.
Yeah,
right.
in the sort of recent time.
Right. Coming back to retail traders, I just wanted to understand that retail traders primarily don't actually have access to spot market prices. I know there seems to be a sort of limitation over there, and therefore it creates a problem in their understanding of basis and evaluation of basis risk, etc. So how does that process sort of improve? How do you see that working out over the next couple of years?
No,
because you need a spot price, a good spot market, and price discovery in the spot market also for people to understand basis.
Yeah, no, it's a great point. It's a great point, and I think that's why establishing that whole price discovery that's happening in India and establishing the MCX price points,
right.
Which can be used as reference in India, is sort of the starting point to that, right? That lays the foundation block. Now, when we look at, let's take bullion,
right?
We do have MCX prices on bullion, which tend to be used across the industry.
Correct.
So you will find it even in like jewelry markets and stores. You will find the MCX
that
price.
That reference price is always the MCX
reference price is available, and in fact, spot prices are quoted off the MCX price.
Right.
Now, in other metals also, we do have the MCX price, and we need to make that information is of course available on our website, is available with many of the folks who are active on the exchange.
Right.
But there's an opportunity to make it more available and accessible to a larger audience as well. When there are global contracts which we run on the exchange, then of course there is also global availability of these prices which anyone can refer. Interestingly, there are very good commodity research analysts.
Right.
And I've seen some phenomenal reports come out of them where they really talk about the whole analysis around price, so on and so forth, just like you find with equity research. And I really look forward to more of that happening. And as we are really growing at this pace, I think that natural demand for more analysis and research being available to the public will also become important.
So while this could hold true for gold, it could hold true for, say, oil and natural gas or metals, what about agri-commodities? Is there a price discovery in terms of the spot market and basis?
No, absolutely. So if you look at, for example, mentha oil, which is a good contract on MCX,
right.
The MCX price is the reference price, on the contract.
Mm-hmm.
So I think agri actually works in a very slightly different way, because many of the large agricultural products don't fall under the remit of derivative exchanges.
Great.
And hence we are looking at slightly smaller sort of niche areas there.
Right.
And the work with the value chain and the work with the participants is very close and very deep. So there really the price is discovered and the price is used and the price is referred on a very transparent basis.
Coming back to retail participants, you have now introduced mini contracts and micro contracts, with lower notional value, and they require obviously lower margins, smaller margins. So you've, for example, introduced this 1 gram gold future contract. I think we call it gold petal, if I'm not mistaken. So has this resulted in an increased retail participants? What's the level of interest that the retail, sort of participant has now in these kind of contracts?
Yeah. So, it's not just retail. I think it's also to bring in wider participation.
Okay.
And wider, even if we look at metals, etc., when we look at mini,
right,
which is smaller denomination,
right,
it helps to bring SME participants.
Right.
So, for example, bullion, metal, etc., are what are called commodity derivatives, which are on a deliverable basis.
Right.
So, in the last 3 days of the contract expiry, if you're still holding the contract, then you have to deliver. So, if you're a retail participant, etc., you're not interested in delivery, you obviously as a financial investor, you move out.
Right.
But if you're a physical industry participant, then you either deliver or you take delivery of the goods.
Right.
So I think that is where the participation of SME starts becoming very important, and the need to have delivery quantities which suit the ecosystem, both from a trading unit standpoint as well as delivery unit standpoint, starts becoming important. So, in order to drive broader inclusivity,
Right.
is really where we look at these, the entire product range, and a fair amount of innovation has happened there. Participation.
So you're seeing increased participation in those kind of contracts,
we do.
like the minis and the gold
Yeah.
leaf and things like that. Which brings me to, if I may just sort of refer back to what you last said, in terms of the settlement itself, there are the SMEs who would like to take delivery, there would be some set of people who would like to take, cash settle the whole thing. So from an understanding perspective for our viewers, I mean, this becomes a little more complicated than, what you see in the equity markets. For example, you seem to have, you have a daily mark-to-market settlement, you have a devolution process, you literally have an option on a future kind of a situation where, those futures then can be cash settled or delivered. So could you give us a little bit more sense in terms of how should we understand this entire delivery mechanism?
Yeah, no, that's right, because an option devolves into a future.
Right.
And that's a very important part of the product design itself.
Right.
So settlement is based on the price,
Right.
Fixed for the day, and margins are really calculated on the back of the positions of the day. Collateral management is there between members as well as participant. There is a fair bit of flexibility there. These margins are also calculated based on past volatility, and there are certain regulatory definitions
Right.
that hold good. Otherwise, yeah, it's not as complicated really.
Right. It apparently looks a little more complicated than the way the settlement happens in the equity derivatives market. So that's why I thought, talking about these margins, you have got exposure margins, span margins, a whole different set of margins out here, which basically are risk containment measures. Could you just give us a little sense about, how risk containment is done in the entire ecosystem?
So it all comes down to the margin, and whatever the margin components are, they are
Right.
all built into the single margin number that's
Right.
arrived at for a particular product. So
Right.
gold will have its margin requirement, silver has its margin requirement.
Right.
There is historical data around volatility that is taken, and of course, conditions, for example, at a time when around the pandemic, when there was a steep collapse in energy prices. So those outliers, also start coming in and having a role
Right.
for a certain period of time. So I
Right.
think these are the various considerations that kick in, and that becomes the kind of margin requirement.
So could you just tell us a little bit more about the physical delivery process? And if, say, somebody doesn't want to cash settle, or you have a future that is, that is physically settled, how does that work?
So, and that's very interesting, because the whole commodity derivatives exchange and clearing system, ecosystem, they sort of create a full industry
Right.
around them.
Correct.
Which then goes back and supports the commodity sector. So there are warehouses
Right.
in which the goods can be delivered and goods can be picked up.
Right.
There are also assaying agents.
Right.
So what the exchange does is, we have definitions in the contract of what we call good delivery.
Okay.
Because these are deliverable contracts,
Right.
which means that if a party were to deliver on the exchange, then it has to be of a certain quality.
Correct.
The quality standard. So many years back, these quality standards were purely based on international quality standards. Over time, we built our own quality standards. These are now also based on BIS standards. So it's great that we have a very strong set of BIS standards.
Right.
So we take the BIS standards, because a lot of our players have imports and exports and all of that, we also study the global standards, and we arrive at working with the industry what are acceptable quality standards to follow, and there could be even different grades amongst them. And then we have a set of testing, auditing, there are certain processes that are there.
Right.
Which then need assayers and testers, so people who understand that particular commodity and who have the ability to work on them. And all of this comes together to create a good delivery, India good delivery, MCX India good delivery. And that is required for delivery to the exchange.
So what is the role that the exchange plays in all this supporting infrastructure? Do they set it up themselves, or do they sort of...
No, I think we work between MCX and MCX CCL.
Yeah.
We work with third parties where required.
Okay, so you work with third parties.
We bring in the expertise where required.
Okay.
We may do some things ourselves. We set the process. We obviously develop the standards, work with industry.
Okay.
Where we need to work with third party experts, we work with third party experts.
And most of these, the physical deliveries would be today mostly in bullion and metal and agri also.
That's right.
Right.
Yeah.
So your natural gas and oil is anyway cash settled.
They are cash settled because you can't bring
crude
oil into our warehouse.
Correct.
But I want to just explain this whole concept of delivery.
Sure.
Because for a pure financial investor who does not want to obviously participate in the physical part of the transaction,
correct,
they can treat the contract on a pure financial basis.
Right.
They just have to make sure that they are not, they square off their positions before the last 3 days.
Correct.
It's in the last 3 days that the contract then starts becoming a delivery contract.
Correct.
And it is the physical participants who are there, and even there, the role of the exchange is a price risk management mechanism. It's a price hedging mechanism for the physical participants, right? Somebody is a manufacturer, somebody is buying and value adding to a product, or somebody is trading, buying and selling the commodity. For them, it helps to manage price.
Right.
It is not meant for delivery.
Right.
It is meant to manage price. But as a point of last resort, delivery of last resort, if you have surplus over and above everything that you had to do, and you still have a surplus, or you have some sort of an extra demand or requirement that is there, then you can utilize the exchange delivery mechanism. So that's the way we look at this.
And if the physical delivery is not available, then you will arrange for the physical delivery. Is that what
No, that's all matched off.
That's all matched off.
That's all matched off.
It's all matched off. So coming back to benchmarking in the commodities market. So you have a series of excess return composite indices, and it would be interesting if you could just explain what this term means. Like the Bulldex, the Metaldex, the Energy Index. You also have a composite index, I think, which is an index of all these. So as an economic indicator, what does that index, what role does that index play? The 9 single commodity indices seem to be a little easier to understand, but if you could just throw a little light on, what is a composite index and what is the need of this composite index and these excess return composite indices that you have?
Yeah. So as you rightly said, if you look at Bulldex is really if you have a play in both gold and silver, then you look at Bulldex.
Right.
If you look at the Metaldex, and if you're a pure copper player, you'll just look at the copper futures or copper options.
Right.
But suppose you're creating an alloy, or you're really dealing in multiple metals, right? Or maybe you're a metals trader, and again you're dealing in multiple commodities, or you want to take a position as an investor on the broader story, the broader infrastructure, manufacturing, construction story, and you just want to take a position on metals, then you look at something like Metaldex.
Right.
So that's really the composite sort of within the commodity categories.
And how would they be weighted, if I may ask?
We do have a very rigorous process that is followed.
Okay.
So there's a pre-established weight based on the data that we have, which is established and available in market.
Because in equities, you have a free float market cap kind of weighting, which is a little easier to understand. So how would we understand weighting in, say, a metal index where you've got these 5-6 metals and you weigh them differently?
So they are predetermined, but they are available. The data and both the process and the approach and the date and the weights are available.
Okay.
The composite index is something that brings sort of all of this together.
Right.
And we'll have a different flavor to how it looks at.
All of this, that's the bullion, the metal, and the natural gas, and oil and natural gas. Okay. Right. And how would you treat that as an economic indicator if you had to treat that composite index?
I think it goes back to what we spoke about on.
So it would be a very good economic indicator because I mean it sort of the entire manufacturing sector gets covered by this index, isn't it?
Yeah, absolutely.
Right. But I don't see too many people using it as an economic indicator.
No, it's something that we need to
sort of push.
Create more awareness, and so that's a job at hand.
Right. But how do these indices compare with, say, the Bloomberg Commodity Index or the S&P World Commodity Index? Are they all sort of?
So the flavor will be India.
Okay. The flavor is India.
Obviously, the flavor is India.
Okay.
Because this does reflect that the global elements, the global price, it reflects in today's age tariffs.
Okay.
It reflects transportation, freight, either shipping freight or local freight, and reflects local value add, and local demand supply.
Right.
So all of that. So really, it's the India play as against what I would call a global play.
Okay. In conclusion, I just wanted to ask you that in today's world,
and if I may also add to this,
right.
When we speak to a number of investors, more sophisticated, maybe more institutional participants, they are looking for, hey, what's the India story?
Right.
Right. So our time is now. Because we started the conversation with all these pieces coming together.
Right.
So really, whether you're within the country or outside the country, you're looking for that India play.
Correct.
And that's what this brings to the table as against.
So that's what I said, that the composite index which you have actually is a very great indicator of where India is going. Actually, it would be the best indicator, possibly better than what an equity index is showing you. And therefore, I think, the use of this index could actually add a lot of value, right? So, I mean, again, coming back into, to the last question that I have, that for a retail trader, right, there is, commodity prices typically reflect a lot of the volatility that is there in both the domestic markets and the global markets. So, if I were a retail trader in, commodity derivatives, where would I get information that I could use to sort of, take positions or to trade the derivatives market? Because information, I think, is at the end of the day the most important thing. If I were a sort of institutional investor or a hedger or a manufacturer, I'd anyway have access to that information. But as a retail trader, how do I get access to that information?
It's a very fair point, and I think we spoke about commodity research reports,
right?
Commodity analysts who are really putting out this data. In fact, more member brokers are looking at commodity desks,
right,
that work with a lot of retail investors, giving them and sort of bringing them up the curve on how to look at this data, what really is the data that they need to be looking at.
Right.
And you will find that today, of course, there's an emergence of the whole app-based trading.
Mm-hmm.
And apps also provide a lot of information to their users. In fact, folks who are registered for commodity do get they can opt for information on gold. So anywhere that news gets published, it is immediately popped up to the user that, hey, this is like news available on gold. So I think there is information out there, and there is more opportunity for us to get simpler, cleaner information, more and easily accessible to retail.
So this information relating to demand, supply, how global prices have moved, all that is available today to a retail trader, or is it only price-related information that is available to him?
So the reports are comprehensive.
Okay.
And the news information that is provided is also comprehensive because there's no filter, it's all news. And then the retail investor will have to, of course, apply their mind to the situation, like in any case. As you say, on the equity side, we say, hey, value investing, understand the portfolio, understand the company, understand the stock, or understand the fund.
Correct.
Similarly, you have to understand the commodity in some way, and that's what this will help.
So, if I may, I had another question which I thought I should ask you. Exchanges today have become tech companies, right? At the end of the day, I mean, this platform is completely technology driven. So, how do you see, technology influencing how exchanges in the commodity derivative space will grow over the next couple of years? Because at the end of the day, it's all about risk containment. It's all about making trading easier, as you rightly said, with more apps coming in, access to market. And I think technology is the backbone of all that.
Technology is driving financial services everywhere.
Right.
And I think in all parts of this value system,
right,
it already plays a role
right,
and will continue to play a strong role.
Okay.
So if you start from outside in, yes, app-based trading where retail is very, very strong.
Right.
Then if you move to a lot of trading today is also very data and technology driven.
Right.
And that's the worldwide trend. We are seeing that in India as well. And then if you come in sort of one level closer, the role of the exchange as well as the clearing house is technology driven in many ways, in the way we have to comply to regulations ourselves, and also in the way that we operate as a first line regulator to market,
right,
whether it's surveillance or et cetera, and all of that also tends to be driven by technology increasingly.
Right.
And then of course, the interface,
right?
How quickly can you onboard a member? How quickly can you onboard a user? All those kind of experiential aspects that kick in.
Right.
And then the core trading, the core clearing kind of platforms.
Right.
As we grow, the need and the sort of necessity to continuously challenge ourselves on raising the game on technology to deliver that growth in a manner that is highly resilient will continue to be important.
So ultimately, the growth in volumes that we are seeing happening and will continue to see happening will mean that a lot more sort of investments will go into technology over the next couple of years in all the derivative exchanges, I suspect.
I think it will happen everywhere.
Right.
Across the industry, wherever there's growth, it'll happen.
Right.
It'll be smart.
Right.
And it'll have to be smart. And it will be in steps, is the way I see it, right? So you plan for X, and at some point when you're closer to X, then you start saying, hey, I need to now plan for 2X and 5X and so on. So we will see that over time.
Right.
I don't believe it will be sort of pro rata, sort of inefficient growth in that way. So it has to have a deep layer of efficiency, and that's really the tech smarts that exist in today's environment to support us through that journey.
So thanks so much, Praveena, for being with us today. And that was a very interesting conversation.
Thank you so much. Thoroughly enjoyed it.